Dear students, good evening again. In the previous lectures, we have discussed about the capital, the different types of the capital. We have a share capital, then we have a common shares, the preferred shares. Today, we are going to discuss one more concept in the capital structure, that is the concept of the bonds or the concept of the debenture. See, whenever the business needs a capital or business needs the investment, they have two sources. Either they can get the capital, this finance from where? From the shares. And in the shares we have two types, mainly the common shares and the preferred shares. We have discussed already what is the difference between the common shares and the preferred shares, so you can refer back to that video and the topic also. Now we are going to discuss the concept of the bonds or the debenture. Just like a capital, just like a equity, just like a shares, the total capital is divided into the small portion that is called as the share capital. In the same way, if the company or in a business want to take a loan, not from one source, maybe from the different people or the general public, so what they do, they just issue the bonds. In the bonds, what is the basic thing? First of all, it is a loan. Now, a loan, especially from the public, it is not a loan from the one source. Normally, a loan from the bank or loan from some, you can say, the insurance company or some financial institution. It is not a loan from that one. It is a loan that is from the public. Means a total loan, just like a capital, it is divided into the small pieces, and those pieces or the small amounts that is divided, that are called as what? As the bonds or the debenture. Now, if it is a loan, obviously it is payable. Now, if it is payable, there is a specific period. Now, specific period means what? That there is some specific, or what we can say, the fixed time period is there. Okay, it may be a 5-year, it may be 10-year, it depending on the loan or depending on the bond term. So it is just an example that it can be a 5-year or 10-year, maybe 6-year, maybe 7-year. It is just an example. It is not a fixed one, but obviously it is more than 1 year. Means the bonds are not for the 6 months or for the 3 months. These are the long-term liabilities of the company. So they are for the specific period, and that specific period is the fixed time period. We are not talking about the perpetual bonds. We are talking about the a limited life bonds or simply the specific life bonds. So that is called as the bonds. It is a loan. It is divided into the small portions, and this loan is taken from the public. The next thing is what? That is the interest. And obviously in most of the cases it is the fixed interest. So the fixed interest means it may be like a 10%, it may be 12%. So it is depending on that what type of the percentage they are fixing. So they are taking a loan from the public, and after specific time they have to pay the amount to the public when the term of the loan or the term of the bond or debenture will finish. So they have to pay that specific amount to them, and during that period, for example, if it is for the 5-year, so they have to pay what? They have to pay some specific interest every year. So the next thing is what? Again, like shares, they have a par value. Now, par value can be a $100, it can be $500, it can be $50, depending on the loan that you are issuing. Again, like shares, the par value is the approved value that the government or the SSCP or the Securities Exchange Commission, so they allow that what will be the par value of the bond. And normally, again, we are discussing the basic one. So normally the bonds are issued at the par value, not below the value or not above the value. Means the premium is there. There's a possibility, and obviously the discount option is also there. But we are discussing that the bonds are the very basic bonds. They have a fixed time period, they have a fixed interest, and they have a par value. And the par value, we just assume, let's say if it is $100, we just say that it is for the 5-year, and the rate of interest is, let's say, 12%. So we have three things: the bond with the par value of $100. So it is issued to the general public. It's like shares. If someone wants to invest in the company but they don't want to take the risk, the risk here is what in the common shares, in the ordinary shares, there is a profitability. Sometimes there's a loss to the company, sometimes there's a more dividend, sometimes there's a less dividend. So there's a risk, and also sometimes there's a possibility that the company is going into the liquidation or the bankruptcy and they may not be getting any amount. So if the person is not willing to take a risk, so they will not invest in the shares, they will invest in the bonds, because they have a specific time period. Just assumption, a 5-year time period is there, and they have a fixed interest rate, means the company has a profit, the company has a loss, but the company has to pay 12% every year. So that is the per annum interest is there, or the per annum you can say the return is there. And then the par value, again, that is the fixed $100 in that case. Obviously it can be more than 100, it can be less than 100 depending on the company. So $100 bonds are issued for 5 years, and every year they have to pay what? They have to pay the 12% interest. So in the start, obviously the company is receiving what? The company is receiving the money which is payable within the 5 years, within the next 5 years. After the term or the time period will complete, they will pay back this money to the public or to the person who is the bond holder, like a shareholder. It will be a bond holder, and then every year they have to pay the interest of 12%, and the interest of 12% is the fixed one. So company has a profit or loss, more profit, less profit, no profit. Even in the case of the loss, they have to pay 12%. And even if the company is unable to pay in specific year, they have to pay it in the next year. Means it will be a liability, and it will keep on the statement of the financial position. They have to show it until they pay this liability, and after 1 year, obviously they have to pay this 12%, and at the end of the 5 year, they have to pay the original amount back to the bond holder. So bonds, so where the company is issuing the bonds to the public, to the bond holders or to the debenture holders for a specific time period, and that specific time period, every year they are paying some specific amount of the interest, and it has a par value. And when this time period will complete, the company will receive the bonds back, or it will be cancelled, or it is called as the redemption of the bonds, and then they will give the money back to the public or to the bond holder. So this is the concept. So for example, if the company is issuing these bonds, so first of all it will be $100 at the 0 time period. Inflow will be there. So this is the inflow, then year 1, year 2, year 3, year 4, and year 5. So every year they have to pay how much? 12% interest. Means this is the inflow of $100 now. So first year they will pay $12, then again $12, then again they will pay $12. For next 5 years they will pay $12, and also in the last year when the time period is complete, so the bonds will be paid, the original amount will be paid. So in that case they have received the inflow of $100, and this is what this all is the outflow for the company. So every year they will pay 12% interest to the bond holders or to the debenture holders. So what is the main difference between the bonds and the preference shares? Because it seems like that here we have a specific life, but in the common shares or in the preferred share there is no specific life. So if we talk about the time period, no fixed time period. Again, in the preferred shares there is no fixed time period. Again here the rate of interest, there is no dividend here, that is the fixed, but here there is a fixed dividend. Maybe the possibility is there, the fixed dividend is there. And again they have a par value here and the par value here, but the main difference is there that it is a payable, it is what, it is a loan, it is a liability, and this is what, this is the shares. So it is the capital or the equity of the company. So this is the main thing. So if you are purchasing shares, you will be the owner of the company, but if you are purchasing the bonds or the debentures, you are the creditors of the company. So it is the liability of the company, you will not be the owner of the company. So obviously they have the voting right, the common shareholders, and there is no fixed time period, and they are the owners. Now, in that case of the liquidation or in the case of the bankruptcy, who will be paid? First of all, the first preference will be given to the bonds or to the debenture holders, and after that, if some amount is left or the balance is available, so it will be paid to the preferred shareholders, and after that, still if there is some amount available, so the third priority will be given to the common shareholders. So these are the owners of the company. It is the equity of the company, but here the bonds or debentures are the payable, or it is simply it is the loan or the liability of the company. So this is the main difference. Then the par value obviously is there in all the cases, but they have a fixed dividend here. There is no fixed dividend, it is a variable dividend, but they have a fixed interest because it is not a share, it is a loan, so they have to pay the interest. Interest is what is the cost of the capital, so what they have to pay the cost which they are saving the amount, so every year they have to pay the specific amount to the bondholder. So this is the main difference between the bonds and the debenture, and these both are the sources of the capital. So the company may issue some of the shares, and again they have a chances that they have a preference, like the common shares they issue, or they issue the preferred shares, and even the company want to take a loan, they have option, either they can go for the bank loan from the one bank or two bank, three bank, or the consortium, or there is a possibility that they are not going to the bank or specific one party, they are going for the debentures when they are taking a loan from the general public. Even the governments are issuing the bonds for the long-term period, and also very important thing, the life is there, but here in the common shares or the preferred shares there is no life, because it is for the end of the company. Until the company is going concern, the bonds will be the shares will be there, but the bonds have a specific life. It can be for 5, 10, but there are some infinite, or what we say the indefinite period bonds are there, but we are discussing the very basic bonds with a specific life. So this is the basic concept of the bonds and the shares. So the bonds are the loan of the company issued to the general public, normally in a small amounts, and then there is a specific life of that, and the company has to pay the interest on that every year, which is normally a fixed interest. So still, if you have any doubt, if you have any question, you can ask me in the comment section. And please keep on sharing and keep on subscribing the channel. Thank you very much.